Hello, everyone. Thank you so much for joining us for our info session today. We're going to give folks just a couple seconds to hop on, maybe about 30 more seconds, just to make sure everyone can join, and then we'll jump in. We've still got lots of folks flooding in, so we'll give it just a few more seconds. Okay. Hello again. Thank you all so much for joining us in our latest Arta Talk series. We're really excited for you to hear directly from KKR today, one of the largest and most successful private equity firms in the world. Before we jump in, I have just a couple housekeeping items for you. We're going to record the presentation portion of today's session to share with any members who weren't able to attend. So you'll hear us stop the recording right before we do the live Q&A. And then I also wanted to mention that I have some important disclosures flashed on the screen for you now. Today's session is not investment advice. It's for illustrative purposes only. And we will host, like I mentioned, a Q&A at the end of the session. We really encourage you to submit your questions through the Q&A function in Zoom. Don't wait till the end. You can submit them all throughout the session. But the questions can't be account specific. So if you have any questions regarding your Arta account, please feel free to email us at membership@artafinance.com, and we'd be happy to follow up with you afterwards to answer those questions. And so without any further ado, I'm going to pass it over to Tracy Gallagher to get us started.
Thanks, Rachel, and good afternoon or good evening, everyone. I am thrilled to welcome Alisa Wood and Matt McGill today from KKR. Alisa is a partner in the firm's private equity business, a member of the investment committee, and serves as co-CEO of KKR Private Equity Conglomerate, aka K-PEC. Alisa is a luminary in the space, having won a number of industry awards, including being named by the Wall Street Journal as one of the women to watch and by Private Equity International as Women of Influence in Private Equity. Matt also joins us from KKR as their head of RIAs for Global Wealth Solutions in the Americas. Lastly, I'll be joining Rachel from Arta's side as I lead our alternative investments business here at Arta Finance. I joined Arta after spending the better part of a decade at LGT Capital Partners, a 100 billion AUM asset manager where I invested in private equity and venture capital firms. More broadly, I've spent the entirety of my career investing in alternatives on behalf of endowments, foundations, and other global institutions, in addition to family offices and individuals. As you just heard from Rachel, we welcome you to participate in the live and anonymous Q&A, so please feel free to submit questions to Alisa, Matt, or myself, and we'll address them towards the end if we don't hit on it over the course of the presentation. So for today's agenda, I'll start off with a brief introduction to Arta. I'll then pass it to Alisa, who will tell us about KKR as well as her views on the private equity market and investment landscape. We'll share more about K-PEC specifically and the unique aspects of the offering. And at the end, of course, we'll turn to live Q&A. So very briefly on Arta. Arta is a digital family office providing high-quality financial services to help you grow, preserve, and enjoy your wealth. We aim to provide you, our members, with a suite of services that have historically only been available to the ultra-high net worths of the world through private bankers or family offices. One of these historically inaccessible products have been alternative investments, which can supercharge a portfolio via lower correlation to the public markets while potentially delivering higher long-term returns than traditional assets like stocks and bonds. Within the world of alternatives, our team sifts through thousands of opportunities in order to partner with a select handful of very high-quality firms and provide our members with vetted access to top-tier funds. That mission is ultimately how we decided to partner with KKR and launch the K-PEC offering, which is now live on the Arta platform for our members. And with that, I will turn it over to Matt and Alisa from KKR.
Thank you so much, Tracy and Rachel, for that kind introduction and the great background as we kick off this call. I'm Alisa Wood. It's great to be with everyone today, and we'll definitely make sure there's time for questions at the end. Thought it might make sense just to start out with K-PEC. What is K-PEC? Why did we do it? And why do we actually think it's so relevant in today's investment environment? You know, K-PEC, and we're not going to go through a lot of slides. We're going to pinpoint a couple here. K-PEC is a one-stop shop into everything KKR does in private equity. And that is really the key here. When you think about the importance of private equity in a portfolio and the importance of having a manager that is that safe pair of hands, that's market tested, cycle tested, knows how to buy good companies that we can make great, and doing it through an open-end evergreen solution, we really think is the win-win. So at the end of the day, when I think about K-PEC, there are three parts of the stool that make it so interesting. One part is the structure itself. The second is what is it actually investing in? And the third are what are the targeted returns and what is the output of what we're trying to accomplish with the first two legs of that stool. And let me break that down for you very clearly, hopefully. Leg one is the structure. The way the K-PEC structure works, is pretty simple. It is an unlisted operating company. At the end of the day, think this is an unlisted version of Berkshire Hathaway. We buy companies at KKR, and that's what this is investing in. So an investor can buy in as a client. You can buy into a current monthly NAV, and you buy into a piece of everything that's in the vehicle already. Today, there are somewhere between 15 to 20 investments in that vehicle, depending on what date you're looking at. And we have had this vehicle in existence since the middle of last year, actively investing. Now, unlike drawdown private equity funds, what's so important is here, you are buying into that current NAV. We are marking that NAV month to month, and that is very differentiated. More importantly, though, is that you're fully invested day one. So you're not having capital calls. You're not worrying about how long it's going to take to commit to the strategy. You are literally invested 100% day one. And we'll walk through the components of what that is. Now, what is also very differentiated is in a closed-end fund, you'll be in that fund for many, many years, 10, 12, 14 plus years. Here, there's an option for quarterly liquidity. That is very unique and differentiated, unlike anything else in the market. And we'll talk through a little more about how that actually works. Now, the other thing that really differentiates K-PEC, and Matt, if you don't mind maybe going to the slide that shows the different building blocks of what K-PEC is. This slide really sums us up pretty simply. We are investing in all of these different building blocks. This is all of what KKR does in private equity. We do small, mid, large size deals. We do US, Europe, and Asia. We make impact investments. We do long dated private equity, and we also do some growth equity as well. Now, in an operating company structure, the vast majority of these assets are going to be in pure buyouts. So 50 to 70% of this portfolio will be in our buyout business, diversified by industry, diversified by geography, diversified by vintage year. Now, we will also do about 10 to 20% in long dated private equity and about 5 to 15% in growth and impact investing. We are targeting about 50% of the capital to be invested in the US and the other 50% to be international. And when you look at the end of the day to go through our industry diversification and our vintage year diversification, what we're really trying to do in a steady state world, which will take us a couple of years to get there, is 100 to about 125 positions. We do somewhere in the neighborhood of 15 to 35 deals a year across all these sub-asset classes and building blocks here. So what this vehicle is doing, and I think this is very important, is it's an uncherry-picked way to invest across all these building blocks. We have a contractual right, K-PEC, we, to share in the deal flow of these building blocks. And what's very important is what we're trying to do is obviously not pass on investments, except if there's some structural, impediments that we could not invest for some reason. The way to think about it is vast majority of this vehicle will be in majority controlled assets, as you can see from the traditional buyout bent here. What is also important is we are not re-underwriting these deals. Okay, we are working with 2,500 people around the firm. They are experts in each of these building blocks. They're experts in geographies and industries. And our team is working with them to make sure we're optimizing the portfolio in the right way. We're optimizing for performance, and we're optimizing at the end of the day for diversification. That is what is so unique. So the structure is very unique, and then what you're investing in is very unique. Now, what is the output of this? The output of this is achieving 12 to 15% net annualized rates of return. Not having a J curve, an investment J curve here is very important, but these assets take time to mature, and these assets take time to grow their NAV. That's what private equity is. At KKR, we buy good companies and we make them great. This isn't about bottom fishing. This isn't about buy low, sell high. This isn't about put a vast amount of leverage on the system. This is all about leaning in, buying good, making great. And the way we make great, the way we achieve our consistent returns cycle after cycle for 5 decades is our toolkit. And I call it our secret sauce, about what we do with those investments to drive the value in them. The vast majority of our returns, 80+% of our returns, come from 2 main drivers. They come from growing the bottom line of our companies, so operational alpha. And it comes from being thematic investors. That's what we are. We come up with broad themes, and then we find investments bottom up that actually fit those themes. That is where the vast majority of our returns come from. Now, note what I didn't say. I didn't say leverage. I didn't say market timing. I intentionally said things that we control. That is our secret sauce. Buy smart, make better, make great. That is what we do at the end of the day. Now, when you think about 12 to 15% annualized rates of return, you may sit there and say, well, how does that compare to a closed-end fund? At the end of the day, a closed-end fund of ours typically would achieve an 18 to 20% net return. Now, that's an IRR, so that's a little different than an annualized rate of return because of the drawdown structure in a closed-end fund. But the reason for that differential in rate of return is because of that bucket there that says liquidity sleeve. 10 to 20% of this vehicle is being held in, cash and near cash securities or liquid type of securities, think short duration liquid credit over time. And we are trying to take very little risk, but achieve, call it 5-ish% returns, 5-6% returns. Today, it's sitting in money markets, as it should with where interest rates are. But that will obviously have an impact on the overall returns. But the trade-off for the liquidity is that return differential. Now, what's so important, and this is one of the other factors of this vehicle, is we are recycling and reinvesting all of our profits, which allows us to supercharge our multiple of invested capital in a very differentiated way. So in a closed-end fund, we typically would be investing and achieving call it 2.25 times multiple of invested capital in 12 to 14 years. Here, because of the lack of investment J curve and because of the compounding nature, what's the saying? Compounding is the 8th wonder of the world. What you get at the end of the day is you'll be able to achieve a 2 times multiple of invested capital in about 5.5 years. It's all net. And somewhere between a 3 to 3.5 or even a 3.7 in a 9 to 10. So because of this structure, you're differentiated on your multiple of invested capital, and you're taking a bit of annual rate of return compression in exchange for that liquidity option. Now, why do I think KKR is such an important manager to be able to do this? It's very simple. This is what we've been doing for 50 years. Literally 50 years. Thematic investors, we take companies private, we buy non-core subsidiaries from businesses, we partner with families and management teams and founders of businesses to find those companies very thematically that we then could effectuate operational value creation and operational change, which will then in turn drive the returns and drive the results. Investing is all about pattern recognition. That's what investing is about. And being in this business for 5 decades allows us to see the patterns, repeat the patterns. And Private equity, unlike any other asset class, has the largest dispersion between your best performing managers and honestly your median managers, let alone your worst performing managers. If you compare it to public equity, the spread is about 200 to 300 basis points. In private equity, the spread is about 2,000 basis points. So what does that tell you? The who you invest with matters more than just being invested in the asset class. Now, why is that the case? It's the case because of what we do with the businesses, the resources we bring to bear. And maybe, Matt, we can go to that value creation slide really quickly further in the deck. What I think is so important are the resources we're pulling in. And the resources include our macro team, where we're coming up with the themes, we're working with our companies to try to think about what can happen in the future and how do we position ourselves against that. Our capital markets team, which makes sure we have the right capital structure in place, which will allow us at the end of the day to support our companies. Leverage isn't just for leverage sake, right? We're using leverage as a way to help the growth and fund the growth of the business. We have our capstone team. And by the way, these teams are very large. Our capital markets team, over 100 people globally. Our capstone team, about 100 people globally. Our macro and asset allocation team of over 40 people globally. But our capstone team looks after and really spearheads the operational value creation work at our companies. Okay, they go in, they teach best practices around Six Sigma, procurement, supply chain, Salesforce management, whatever the topic may be. They're not in lieu of management, and then they get out. That's the goal. We also have a global institute, which helps us think about geopolitical opportunities and risks, and how do we assess that? How do we ring fence risk, price risk? Think about mitigate risk. But all risk isn't bad at the end of the day. Risk can be opportunities, and that's the way we think about them. And then the final piece is our advisors. Hundreds of advisors around the world. These are people you would know. You would read in the Wall Street Journal. Retired CEOs from Johnson & Johnson, from Danaher, from very large businesses, founders of businesses, founders of innovational models like Domino's Pizza, and how we think about the franchisee model. These are folks who work with our companies, work with our investment teams to come up with the themes, to execute on them, and to find the right businesses that we can go drive value in. Now, what I might spend a second on, if we can go back to the page on themes, what are we seeing in the market today? I think at the end of the day, we've proven that private equity is a very interesting asset class. I think our returns show, as you can see in the slides, that we've done this for a very long time and have done it well. You know, just to maybe drive a finer point on that quickly, we typically target 700 to 800 basis points above the public market, cycle after cycle, in periods of dislocation like the one we're in now. And we have some slides on this. I'll let you look through it at your leisure. We typically see 2 to 3 times that for periods coming out of dislocations. So we think we're really well positioned. Now, how do we actually go do that? What's in the portfolio? And what are we excited about today? Maybe I could skip back one page to the types of, one more maybe. Maybe the slide which yes, that one. Sorry, one more back. Yes, perfect. The types of deals that we're seeing in this market, and I referenced this earlier. Sorry, Matt, to make you pop back and forth here. We are doing more take privates in this market than ever before. Now, it's something we've done a lot of, but when you look at the public markets and the dislocation, the very, very large companies are doing well. The tech companies at a large scale are doing well. But if you look at mid-sized companies, they're truly orphaned, unloved assets, especially if you're looking at less sexy industries like industrials. So a business that we just took private is a company called Circor. All the examples I'm going to use are in this portfolio, just so you know. Circor is a company that we took private last summer, closed on it in the fall. They make flow control devices. Okay, not very exciting. They do it in the industrial and the aerospace and defense area. They are a leader in it. They're best in class in it. We know this space really well, having owned some of their competitors, but they were just getting beat up in the public markets. And this was a great business that we could do some heavy lifting operationally behind closed doors. So we were able to take this private, and we're working through that value creation plan right now. There's also a number of M&A opportunities we can further supercharge the growth through. Corporate carve-outs are a big piece of our bread and butter of deal flow. We've done more of these than literally anyone in the market. We've bought from every major conglomerate that you can literally point to. We recently bought a company called Simon & Schuster. I think everyone will know this one. It's a book publisher, the number 3 book publisher in the world. In 2003, they had about 250 titles and published over 250 million books. Massive business, big audio business, but they were owned by, at the end of the day, a large media conglomerate. Everyone will know this name, Paramount Global. Paramount Global was not very focused on running them all that efficiently. They were a non-core subsidiary. They were a small non-core subsidiary, not small to us, but small to them. So this is one where we could buy the business. We could focus on the growth. We know the audio book space very well by owning RB Media. We know how to make this company a lot more efficient from a bottom line standpoint. And we really can bring some best in class practices here. The best way to think about it is they're very, very inefficient with some of their financial forecasting. They lose close to an amount a year equal to their profits in the misprinting of different titles. Pretty remarkable, right? This is a business that at the end of the day, a lot of international expansion opportunity, but also think about it as like what Zara did to fashion, right? Just-in-time production, localized supply chains, really taking a global business and making it much, much more localized. We could do the same here. And that's one of the really exciting factors of that as well. One other one, and maybe if we can go to the theme page now, I'm going to bounce around a little bit, that really talks to another type of deal, but also a different theme of deal is health and wellness, but partnering with families, partnering with entrepreneurs, partnering with management teams. This is one where when you think about one of the themes that we invest behind, changing demographics, people living longer in life, people having children later in life. The fertility landscape has fundamentally changed in Europe in particular. It's extremely fragmented. There's very much of a focus on independent individual care models, a bit different than the US, where a lot of the care in this space in particular centers around hospitals and universities. In Europe, it's much more of the clinician model around a clinic and a doctor. So this doctor did a roll-up of these across Spain. And what he thought at the end of the day was, if I did this across the rest of Western Europe as the regulation was changing to make fertility practices much, much more commonplace, how neat would it be if I actually had a partner who could help me fund capital, but also help me bring best-in-class practices to the table, who knew M&A and knew how to run businesses operationally to create the synergies out of it. So today, EVRMA is doing just that. We own 73 clinics across Europe. We're in 9 countries. The doctor sold us his business in Spain. He rolled 100% of his profits back into the company, and we're continuing to do that roll up across the rest of Europe. And maybe I'll give you one more thematic. It's where digitalization intersects at the end of the day with sustainability as an example, or energy transition. We look at data. Data is the fastest growing commodity in the world. And when you look at AI and big data and IP traffic, what's really driving a lot of that use of data at the end of the day is, obviously it's impacting everything we do all over the world, right? Now, lots of themes to lean into. Cybersecurity, how do we think about workforce transformation? How can technology really step in for that? But at the end of the day, all of that being said, and we're investing in a lot of themes there, all that being said, one of the things that we've really noticed was how much energy data centers are using. And data centers are growing exponentially right now because the data's got to be housed somewhere as everyone's using it and consuming it and relying on it. So what happens at the end of the day is an average data center, and you look at data centers as a whole, are using somewhere between 4 to 5% of global energy usage. If you fast forward 10 years, it'll be somewhere between 9 and 10%. Now, Why do data centers use so much energy? It's because they heat and cool, I should say, a data center similar to the one that's in this office right now. It's an HVAC system, very inefficient. And one of the things that we have invested in here is Cool IT. It's a business that actually uses a liquid cooling agent to cool the semiconductor chips directly, which means that instead of relying on an HVAC system, the air is not even getting a chance to get hot because we're cooling it down much, much faster. So this liquid cooling agent will cool a unit of heat about 2,500 times faster than air. Remarkable. What it does is it reduces data centers' usage of energy by 30 to 40%. Very important. So these are some examples of things that are in the portfolio, things that we're leaning into, types of deals that we're seeing, and really why we're so excited to be able to very consistently deliver performance cycle after cycle, regardless of what the interest rates are, because of the fact that we're relying on the bottom line growth of the business and being thematic investors. That's really what it comes down to at the end of the day. So with that said, I know I covered a lot of ground. The only example that I probably haven't talked about, which I think actually might be, there were one of the questions in the chat about this, was around universal ownership. And I would say this is probably one of our newer areas, probably in the last 5 to 10 years, that we've been leaning into to drive value. Is it actually a page of our own book, out of our own book? We are the largest investor in everything we do in private equity, right? And this is one of those moments where we believe that creates the ultimate alignment of interest with our clients and with anyone who would be investing with us. Now, what is so important at the end of the day is making sure that everyone at KKR are also owners and they're also invested in everything we're doing, to make sure that it's not, we're creating the alignment of interest in a way where we can drive value and sit side by side with our clients. But why shouldn't the employees of our companies have that same alignment? The answer is they should. Now, if you look at a CIRCOR, which we just talked about, if you look at a Simon & Schuster, which we just talked about, if you look at any of these companies, what we're doing is we're leaning in a very big way to give universal ownership, to give equity ownership to all of the employees of these companies. Okay. And what that means at the end of the day is they act and feel like owners. They do things that otherwise they probably wouldn't have been incentivized to do to make sure the companies are growing more efficiently. And that is really one of those last arrows in our quiver, one of the last tools in our toolkit to continue to be innovative drivers of value creation, to create alignment of interest and to create bottom line growth across our businesses. So with that, Matt, I don't know if I missed anything. Tracy or Rachel would love your thoughts on how best to go from here, but hopefully that really talked through where we are today and what we see the opportunities at being.
Maybe just a quick one before we jump into the formal Q&A, although I'm a little bit cheating because I know this was a question, but would love if you could touch on why you decided to launch K-PEC and expand into the accredited investor universe.
No, absolutely. I think that's a great question, Tracy. One of the things that I think is so important is, well, really two things. One, the need for private equity in a portfolio is important regardless of the size of the investor. You could be the largest institutional client, you could be an individual investor, it doesn't matter. Private equity has really, as we've seen a compression of returns in other asset classes, as we've seen correlations change between asset classes, private equity is really that asset class that has closed the return gap for so many investors. And what we've really tried to do is take what is the heart of KKR, private equity, heart of KKR, and create it in a more interesting or different type of structure, which will allow individual investors to invest directly and do so in a very thoughtful way. Well, this is not a fund of funds, right? This is investing deal by deal, right? So it's an extremely efficient structure with that evergreen, semi-liquid overall framework to it, which I think is a very interesting thing. So at the end of the day, there is that element of, we do believe everyone should have an opportunity to invest in private equity, and let's help facilitate that. The second thing that I think is very important is, honestly, what's in it for us? If I'm going to be really blunt on that, what's in it for us is certainty of capital. So if you look at the last 21 years that I've been at KKR now, what we've seen is a few things. One is companies continue to get larger. Two, there is more of an equity need to buy companies than ever before. Less leverage is available. This isn't the 80s anymore, right? They're prudent levels of leverage. And I think that's good for all of our investments, but that's just a reality that we have to deal with. But three, our institutional pools of capital, while they have grown, they haven't grown commensurate with the opportunity set. So what we're trying to do is find more reliable sources, certain sources of capital that allow us to have certainty when we do deals. Right now, we're whatever equity gap we have, which by the way is billions and billions of dollars. If you look at the last 10 years, it's about $35 billion, or even now it's probably even closer to $40 billion of equity gap. We're funding it with co-invest dollars. And while that is efficient for right now, we're calling hundreds of co-investors every time we bring co-invest. That doesn't work when you're trying to sign a deal. So what we're trying to do is be very thoughtful around how do we continue to have certainty around sources of capital that we can make sure we're signing deals, doing deals, continuing to drive those returns that many of our investors, all of our investors have really come to need and rely on, but do it in a more interesting, novel format.
That's super helpful. I guess, Matt, if there wasn't anything else that you wanted to touch on, maybe we could jump to the formal Q&A, even though I did jump the gun here, but double checking with you.
No, that's great. I think let's use the next 10 minutes with whatever questions would be most helpful for you and the Arta members.